Usually when you walk down the aisle of a grocery store, there's this ingrained expectation of success when you see a sea of those brightly colored yellow sale tags.
Oh, totally.
Right. Like you see a massive end cap loaded up with a brand's products, giant font screaming 20% off or buy one, get one free. And your immediate thought is, wow, this brand is aggressive.
Yeah.
They are dominating the shelf space, capturing attention, and just clearly winning the market.
It creates a tremendous visual illusion of strength, really. To anyone just walking by with a shopping cart, it looks like a brand taking charge, moving massive amounts of product and, just leaving their competitors in the dust.
Exactly. It's loud, it's visible, and you just assume the people back at corporate are high-fiving in a boardroom somewhere over those sales numbers.
You'd think so, yeah.
But, and this is the crazy part, when you peel back the layers of the consumer packaged goods industry right now, suddenly those bright yellow tags don't look like victory flags anymore. When you actually understand the mechanics behind them, they start looking a lot more like distress signals.
It is the absolute definition of a dashboard illusion. What looks like massive, undeniable growth to the untrained eye is actually hiding a really deep structural fragility within these companies.
Welcome to the deep dive. Today, we are exploring a massive paradox in the consumer goods world. We're looking at why seeing more sales, more discounts, and more promotional pressure at the store might actually be a giant red flag that a brand is internally struggling.
It's a huge issue right now.
It really is. And we've got a fascinating grounding source today for you. It's an article by global growth expert Denise Drummond-Dunn. It's from her C3 Centricity Marketing Deep Dive series, and it's titled Beyond the Discount: Restoring Growth in CPG Promotions.
It's a brilliant piece of analysis.
Okay, let's unpack this. Because right now, everyone, brands and shoppers alike, feels the weight of these constant promotions, but actual unit growth in the market is completely stalling.
The central tension Denise isolates here is this idea of activity versus actual growth. The business feels like it's running faster, the trade spend climbs to astronomical levels, but the foundational growth story is incredibly fragile.
And just for anyone unfamiliar, trade spend is the massive bucket of money that brands pay directly to retailers.
Exactly, yeah. It's what funds those yellow tags, the premium shelf space, the catalogs. It is often the second largest expense on a brand's profit and loss statement, right behind the actual cost of making the product itself.
Wow. Okay, so I want to pose a question directly to you, the listener. Think about your own habits for a second. When you buy something on sale at the supermarket, are you discovering a new favorite brand that you're going to stick with forever and pay full price for next time?
Probably not.
Right. Or are you just gaming the system, waiting for a price drop on something you were probably going to buy eventually anyway?
Yeah.
Because that very simple question is exactly what is currently keeping consumer packaged goods executives awake at night.
The data tells a very clear story that consumers have absolutely learned to game the system. But before we can figure out why this toxic cycle is happening inside the corporate offices, we really have to look at the sheer scale of what is actually happening out there in the retail aisles.
So let's look at the numbers in Denise's article, because they are staggering. We have data from Nielsen EQ's 2026 Western Europe analysis, and they are unusually blunt about the situation.
They really didn't hold back.
No, they didn't. They show that promotional pressure is rising significantly, but unit growth is slowing down, meaning brands are putting more and more of their portfolio on deal, spending all that trade spend you just mentioned, but they aren't actually selling incremental units.
Exactly. They are spending more money to move the exact same amount of stuff. What's fascinating here is how the internal corporate metrics completely detach from reality. Like, let's look at the UK grocery market as a prime example of what promo intensity looks like when it stops being a special event.
Right, when it just becomes normal, everyday shopping behavior.
Yeah. According to Kantar, promotions reached 28.2% of total grocery spending in March of 2025. That was a 4-year high for the region.
And it didn't even slow down, because by October of 2025, Reuters reported that nearly 30% of UK grocery spending was directly tied to promotions. Almost a third of the money changing hands in a massive national supermarket system was only happening because of a deal.
It's wild to think about.
It is. And here's the kicker. Promotional shopping grew a massive 9.4% in that period, while full-priced items barely grew at 1.8%.
But think about the human behavior driving that 9.4% spike. People aren't suddenly consuming 9% more food or washing their hair 9% more often just because things are on sale.
They're just pantry loading.
Exactly.
Yeah.
If a shopper buys 3 bottles of shampoo because of a deep discount, the brand's dashboard flashes green for that week. But that consumer is now effectively vanishing from the market for the next 6 months.
Because they already have all the shampoo they need.
Right. They've cannibalized their own future full-price sales to hit a short-term target today.
And you might think that's just a European phenomenon, but the U.S. version of this problem arrives through a slightly different door, even though it lands in the exact same room. In the U.S., it's characterized by what Circana's 2026 outlook calls volume tightness.
That phrase perfectly captures the squeeze. When you examine the U.S. data, top-line revenue numbers look totally fine on paper. But when you look closer at the mechanism, that revenue growth is being driven almost exclusively by price hikes.
Price hikes and shifting the product mix to more expensive items, yeah.
Exactly. The actual volume, like the physical amount of boxes and cans going into people's carts, is flat or even dipping negative.
Yeah, Circana showed that U.S. retail sales revenue was completely flat across food and consumer packaged goods in the 5 weeks ending January 3, 2026. But underlying unit demand actually dropped 1% compared to that same period in 2024.
This is the dashboard illusion operating at maximum capacity. It looks incredibly busy and productive for the executives staring at their screens. The promotional spikes create these little bursts of revenue that keep the overall top line looking steady enough to survive the quarter.
But the underlying mechanics show that you aren't creating new buying behavior.
No, you are simply training your shoppers to wait. You are shifting the timing of the transaction, not the volume.
It reminds me of giving a kid a massive dose of sugar. You hand a toddler a giant lollipop, and for 10 minutes, they're running incredibly fast.
Oh, that's a perfect analogy.
Right. If you were just a manager measuring speed on a dashboard, you'd say, wow, look at that performance spike. We are crushing it. That's the promotional sale. But then inevitably the crash comes.
The sugar crash.
Exactly. And more importantly, that sugar rush didn't actually make the kid grow any taller. It didn't build bone density or muscle mass. It was just an illusion of growth. Growth that only happens on a deal isn't growth at all. It's dependency.
That is a brilliant way to visualize the mechanism at play. And that dependency is dangerous because it masks a fundamental weakness in the business model. The central commercial question isn't whether throwing money at a promotion drives a temporary spike in sales.
Because anyone can do that.
Right. Any brand can buy temporary volume if they drop the price low enough. The real question is whether that promotion creates incremental units and repeat behavior after the deal ends.
But here's the craziest part of the whole source material to me. We have all this clear, undeniable data. Western Europe is seeing slowing unit growth. The U.S. is seeing flat or negative volume. It is painfully obvious that this discount dependency doesn't drive long-term volume.
Right.
So what do the executives do with this information?
They double down.
Yes. According to Deloitte's 2025 Consumer Products Industry Outlook, 76% of surveyed executives plan to offer more sales discounts or promotions than they did the year before.
They look at the sugar crash, and their solution is to just buy a bigger lollipop.
Exactly. If the data so clearly shows this isn't working for long-term growth, why on earth are 76% of highly paid executives reaching for the discount lever? We have to look past the grocery store shelves and look at the sheer exhaustion happening inside these corporate boardrooms to figure out what's really going on.
You really do. To understand the reliance on the discount lever, you have to look at the underlying sickness in the industry right now, which is a massive failure in innovation.
Right.
Denise points out that promotions have quietly become a coping mechanism for the fact that brands are struggling to invent new, exciting things that people actually want to pay full price for.
And the Nielsen IQ data on Western Europe paints a pretty grim picture of this. They reported closing 2025 with FMCG, fast-moving consumer goods, value growing 3.4%. But again, the mechanism there was driven almost entirely by higher prices.
Because at the exact same time, actual innovation sales declined in both value and total units.
Right.
Innovation failure looks like a brand launching a quote-unquote new product that is just their existing potato chip made slightly spicier, or putting the same lotion in a slightly differently shaped bottle. Consumers see right through that.
They won't pay a premium for it.
Exactly. And when that shallow innovation stops pulling its weight, panicked teams look around the room and ask the promotions department to compensate. They have to hit their quarterly target somehow. The core proposition of the brand has lost its clarity, so they use a deal to cover it up.
Hold on. These are billion-dollar global brands with endless resources. You're saying their pricing strategy, the very thing we see dictating the global retail market, isn't some high-level chess game, but just exhausted managers throwing a 20% off sticker on a box so they can hit a quota and finally leave a meeting.
It sounds absurd to reduce global corporate strategy to that level, but the source material highlights this as a major structural factor. It brings in this concept of the coordination load.
The coordination load, what does that mean exactly?
Well, modern corporate structures have become incredibly exhausting to navigate. Asana reports that 60% of a person's work time is spent on work about work rather than actually doing skilled work.
60%.
Yeah, that means managing emails, updating tracking spreadsheets, and sitting in cross-functional alignment calls.
So out of a 40-hour week, 24 hours are just managing the bureaucracy of doing the job. That is wild.
And Atlassian supplements that by reporting 78% of people surveyed say they're expected to attend so many meetings, it's genuinely hard to get their actual work done, and 76% feel completely drained on those meeting-heavy days.
So picture the environment. You have a team that is drained, overwhelmed by this coordination load. Their superficial new product launches aren't landing with consumers, but corporate leadership is still demanding that 5% growth target for the quarter.
In that environment of high pressure and high exhaustion, a promotion feels like a beautifully safe, tangible action. It is a familiar, pre-approved playbook. You don't have to invent a new product or launch a complex marketing campaign.
You just say, we are running a 15% discount for 3 weeks.
Right. It satisfies the retailer who constantly wants more trade investment. It satisfies the finance team who can easily model the margin hit on a spreadsheet. And it satisfies leadership because it guarantees immediate, visible activity.
Even if it's just a sugar rush that cannibalizes next quarter's sales.
Exactly. That brings up a fascinating dynamic about the corporate meetings themselves. Many of these promo planning meetings aren't actually gathering to make a strategic decision. The source identifies that they are gathering purely to reduce anxiety.
Oh man, the anxiety meeting. I think anyone who's worked in a corporate office knows that feeling in their bones.
Oh, for sure. Anxiety meetings multiply work and they postpone clarity. People just stare at red numbers on a screen and agree to do something, anything, to make the numbers turn green for a week. But true decision meetings shorten work and create momentum. And for you listening, connecting this directly to your own career, the source makes a brilliant point. Your value as a leader rises dramatically when you become the person who recognizes an anxiety meeting and turns it into a decision meeting. Nobody builds a legacy or gets promoted to the C-suite for just running another generic discount.
No, they don't.
You become invaluable by building growth that holds up when the discount stops.
Okay, so we've diagnosed the sickness.
Yeah.
We've got exhausted teams, suffering under coordination load, failing innovation, and companies using discounts as a giant Band-Aid to hide the fact that consumers don't want to pay full price for their products anymore. But how do we actually cure it?
Well,
Because the source explicitly notes that becoming completely anti-promo is not a credible option. You can't just stop promoting altogether. Your retailers would drop you, and your competitors would eat your market share instantly.
right. A position entirely against promotions isn't credible in the modern retail environment, but a position demanding rigid discipline is. And the cure starts with portfolio clarity. A company has to admit that not all brands or products in their portfolio serve the same strategic purpose.
Think of a brand's portfolio like a sports team. You have different players for different roles. Some brands are meant to be promo-led. They are the defenders. They exist to be the volume driver, the aggressive deal that gets foot traffic into the store and blocks competitors.
But other brands in your portfolio must be preference-led. They are your star strikers. They have to rely on strong consumer preference, high quality, and brand loyalty, not price. Because those preference-led brands are the ones that actually fund your profit margins and pay for your future innovation.
And if a drained management team blurs those roles and just applies blanket discounting across everything to hit a quarterly target.
They are training the consumer to wait for deals across the entire portfolio. You cannibalize the margins of your best products.
Here's where it gets really interesting. Denise introduces a brilliant framework called the Promo Truth Test. It's designed to be used in those draining anxiety meetings to force clarity without starting a corporate turf war.
It's so effective.
It consists of 3 specific questions that disrupt the autopilot discounting cycle. Let's look at the first one. What specific behavior is this promotion actually meant to change?
That question is a circuit breaker because it forces the room to look beyond the vague goal of moving units. It demands a mechanism. Are you running this deal to drive trial for a brand new product? Are you trying to get a lapsed customer to repeat a purchase? Are you trying to get a loyal buyer to trade up to a premium size?
The actual mechanics of the promotion have to match the human behavior you want to trigger.
Exactly.
Because if you just slap a massive 50% discount on a product to drive trial, sure, it might work once, but it's the difference between renting and buying. A deep discount just rents a customer's attention for a weekend, but a strong brand proposition buys their loyalty.
That's a great way to put it.
Right. A discount might get them to put the item in their cart, but if there's no underlying quality or reason for them to return and buy it at full price next month, your promotion wasn't a sale.
Yeah.
It's just incredibly expensive product sampling.
Which perfectly sets up the second question in the truth test. What is the stop rule?
I love the mechanics of this one. What does failure look like so we can objectively stop running this promotion?
It is astonishing how rarely that is defined before money is spent. Promotions often just keep running on an endless loop year after year because nobody in the room agreed beforehand on the specific metrics of failure.
They just assume it's working.
Right. By establishing a stop rule, saying, if this doesn't drive a 15% increase in repeat purchases within 2 months, we pull the funding. You turn a promotion from a mindless corporate habit back into an actual measurable strategy.
And then we get to the third question, which is the ultimate test of brand health. What do we want to be true about this brand in 6 months that discounts alone cannot buy?
Asking that in a meeting completely changes the temperature of the room. It shifts the discussion away from the frantic short-term panic of how deep of a discount should we offer this week, and forces the team to focus on preference, trust, and long-term pricing power. You cannot discount your way to brand loyalty.
If we connect this to the bigger picture, what we're really talking about is shifting the company's addiction away from deep margin-killing price cuts and moving toward what the source calls confidence-building mechanics.
Confidence-building mechanics are promotional strategies that change consumer behavior without permanently lowering their psychological expectation of what your product should cost.
Like what? Give me an example.
For example, instead of slicing 30% off the price of a premium face cream, you offer a trial format, like a smaller, cheaper version of the product. This reduces the financial risk for a new buyer who wants to test it, but it entirely preserves the premium price perception of the full-size product. Oh, that makes total sense. Or bundling items. Like, if a shopper is confused by a complex product line, bundling a razor with a shaving cream simplifies their choice and provides value without training them that the razor itself is fundamentally cheap.
Exactly. You can also use brand activations like in-store experiences or digital campaigns that highlight the actual proof of your product's quality rather than just slashing the price tag.
And if a team finds themselves hopelessly stuck in that autopilot promo loop, unable to break the habit, Denise details a couple of specific frameworks in her article to force a reset. She mentions QC2, which acts as a fast diagnostic lens.
Yeah, instead of spending months debating why a brand is failing, QC2 isolates the variables. It asks, is our issue a lack of brand role clarity, a failure in the actual consumer value of the product, or just friction in our retail execution? It stops the endless arguing and pinpoints the exact leak in the ship.
And she also mentions cat sight. I love how this works mechanically because it takes a vague, anxiety-inducing corporate mandate like we need 5% growth by Q3 and translates it into reality. It forces the team to identify exactly who is going to buy the product, what specific action they need to take, and why they would take it. It shifts the focus entirely from hitting a spreadsheet target to altering actual human behavior.
Because ultimately, post-promo behavior needs a lot more respect than it currently gets in this industry.
Right.
Repeat purchase is the absolute ultimate truth test of a company's health.
It really is. If a shopper buys your product on a steep deal but then refuses to buy it again at full price after the yellow tag is gone, that is a glaring signal that you need to fix your product proposition. Your customer experience is broken.
Yeah.
It is a catastrophic mistake to view that lack of repeat purchase as a signal to just run an even deeper discount next month.
So what does this all mean? If you take nothing else away from our time together today, let it be this.
Yeah.
Don't be the person in your company who just manages trade mechanics and endlessly updates discounting calendars.
Right.
Be the person who builds genuine consumer preference. Be the person who asks the hard questions about behavior change and protects the margin. Your career value skyrockets when you become visible as a genuine growth leader who forces clarity. rather than just someone stuck in the exhaustion of endless execution.
But it requires real discipline to hold that line, especially when the dashboard is flashing red, the meetings are draining, and the absolute easiest thing to do in the world is pull the discount lever one more time.
It really does. A huge thank you to the insights from Denise Drummond-Dunn for anchoring today's discussion. If you want to dive deeper into this and equip yourself with these tools, you should absolutely subscribe to the C3 Centricity channel and visit c3centricity.com. She has brilliant, actionable ideas on there, and you can even book a free business makeover session to help reignite momentum in your own career and fundamentally change the way your company operates.
And before we go, I want to leave you with one final thought to mull over. We talked about how nearly 30% of a massive economy's grocery spending is currently just consumers waiting for a discount to buy the exact same amount of stuff. The volume is flat, but the promo activity is frantic.
They're running as fast as they can just to stay in the exact same place.
Right. So play this out to its logical conclusion. What happens when inflation stays high? Supply chain costs remain elevated, but these companies simply cannot afford to lower their prices any further to fund these deals.
That's a scary thought.
When that promotional lever finally breaks from years of overuse, who blinks first? Is it the brand that can't afford the discount, the retailer demanding the trade spend, or you, the shopper, standing the aisle expecting a deal that is never coming?
Next time you walk down that grocery store aisle and you see that endless sea of bright yellow tags, just remember, you aren't looking at a sign of strength. You're looking at a system pushed to the absolute brink, hoping you'll take the sugar rush and not ask any questions. Thanks for joining us on The Deep Dive.